2 months ago, it was literally the most hyped IPO in market history. We saw a staggering $1.7 trillion valuation, with retail investors absolutely climbing over each other to get their hands on shares of SpaceX. But today, well, the narrative has completely shifted. We are entering what is undoubtedly the most critical 48-hour window in this company's short life on the public markets. The stakes absolutely could not be higher, and we're going to break down exactly what is happening in this explainer.
To wrap our heads around the gravity of this moment, we really have to look at the sheer scale of the carnage first. Since June, over $1.2 trillion in market value has been completely wiped out. I mean, the stock has essentially been cut in half, dropping a massive 50% from its peak. This isn't just a minor correction, it's a historic evaporation of wealth. The stock closed lower in 13 of the last 16 trading sessions, leaving a lot of investors reeling.
So, what does this all mean? That massive drop sets the stage for the ultimate question we are answering today. Will SPX crash straight through the floor, or will it stage one of the greatest comebacks in market history? Over the next 48 hours, the company faces two massive back-to-back tests. First, their very first public earnings report, and that is immediately followed by a massive lockup expiration. How the stock handles these two events is going to dictate its survival.
Section 1. The Rise and Fall. SPCX's Volatile Journey.
Let's trace exactly how we got to this ticking clock, because the timeline here is just breathtaking. On June 12, 2026, SpaceX went public at $135 a share. They sold over 555 million shares, raised $85.7 billion, and it was literally the largest initial public offering ever completed. Just 4 days later, on June 16th, absolute market euphoria pushed the stock to an intraday peak of $225.64. That is a 67% gain essentially overnight, briefly pushing the market cap near $3 trillion. But then, the bears took control. After a really fierce battle in that $150 to $170 range, the selling pressure just completely overwhelmed the hype. Fast forward to today, August 4th, and it's trading below $115. That means it's currently sitting below its initial offering price.
Section 2. Q2 Earnings Catalyst, the first public report. That brings us to the very first massive hurdle hitting the wire today. After the closing bell, Wall Street gets its very first audited look at SpaceX's balance sheet, their revenue, and operating margins. Here's exactly what analysts are projecting. They're looking for revenue to hit around $6.82 billion. Now, that would be a really solid jump from the $4.7 billion they reported back in Q1. Adjusted EBITDA is expected to come in at about $2.05 billion, with an adjusted loss per share sitting somewhere between 23 and 24 cents. Now, keeping the long-term view in mind, analysts are actually modeling for full-year 2026 revenue to reach $39 billion, with EBITDA around $17.3 billion. So today's numbers absolutely need to show they're on that trajectory.
But, investors aren't just staring at top-line revenue. This brilliantly illustrates the complexity of valuing this whole enterprise. They are obsessively watching 4 very specific operational metrics right now. First up, Starlink profitability. Subscriber counts and cash flow are the primary valuation drivers right now. Second, launch margins. Just how profitable are those Falcon 9 and Falcon Heavy flights? Third, Starship spending. Everyone wants cost guidance here, especially after the recent test flight setbacks. And fourth, AI infrastructure. SpaceX is currently leasing compute capacity at a premium to giants like Google and Anthropic. Analyst Julie Zhu from MoffettNathanson actually hit the nail on the head, pointing out that SpaceX is facing a bit of an identity crisis across these sectors. She argues that the launch business is the true crown jewel, because without those rockets, the connectivity network and orbital data centers simply do not exist.
Section 3. The $100 billion cliff. Lockup expiration.
But hey, earnings are really only half the story here. The second catalyst has everyone on Wall Street holding their breath. Just 2 days after earnings, we hit a massive lockup expiration. Now, for those unfamiliar, a lockup expiration is simply the date when early investors, company insiders, and employees are finally legally permitted to sell their shares. Remember, when SpaceX went public, only about 4 to 5% of the total shares were actually available for public trading. The rest were restricted. Well, on Thursday, those floodgates open.
This is where the numbers get truly staggering. Look at the sheer volume of this incoming supply shock. Right now, the active public float is roughly 640 million shares. But unlocking on Thursday? Somewhere between 911.5 million and 930 million shares. We're talking about over $100 billion worth of equity suddenly becoming eligible for sale. This single event will roughly triple the current tradable float. Now, even though it's a staggered release, with 20% of the 180-day shares unlocking now, another batch after Q3, and Elon Musk restricted for a full year, the market is terrified. They're terrified of just how much of this new supply is actually going to be sold.
And that fear is perfectly captured by Morningstar analyst Nicholas Owens, who bluntly notes, "We believe that most of the available shares will come to market because the existing sellers have low cost basis and long holding periods." Essentially, he's saying that even with the stock down 50% from its peak, these early employees and private investors are sitting on absolute mountains of paper gains. The temptation to cash in and secure those profits is just incredibly high right now.
Section 4. Wall Street short sellers. Bearish positions. Anticipating this massive flood of shares, the sharks are definitely circling. Short sellers have built an absolute mountain of bets against SPCX. As of late July, short interest stood at a staggering $24.6 billion. That represents 219.3 million shares shorted, making up about 34% of the public float. Just to put that in perspective for you, these bets completely dwarf the short interest in Tesla. Wall Street's most aggressive traders are putting their money on a crash.
And here is the crazy part. These short sellers are already winning. Since the IPO, they have amassed $8.3 billion in paper profits. According to data from S3 Partners, the real driver for these traders isn't even today's earnings report. It's that lockup expiration. They are aggressively betting that no matter how good the earnings numbers are, absolutely nothing will be strong enough to absorb the shockwave of nearly 1 billion newly tradable shares hitting the open market.
Section 5. The bull versus bear debate. Valuing SpaceX. With all these extreme forces at play, we have this massive, intense tug-of-war happening. When we neutrally look at the arguments, the division is incredibly stark. On the bear side, critics point out that at $1.4 trillion, the valuation is just completely detached from near-term cash flows. They highlight massive cash burn. I mean, SpaceX lost $4.9 billion in 2025 and $4.3 billion in just the first 3 months of 2026 alone. You add in the Starship setbacks and the massive $60 billion all-stock dilution from acquiring the AI platform Cursor, and some bears see fair value all the way down at just $30 a share. But the bulls? They look at this exact same picture and see a generational opportunity. They argue the 50% drop has already priced in all those lockup fears. Firms like Macquarie are calling this a rare window to buy a category-defining infrastructure platform at a steep discount. They believe a drop below $100 would essentially mean the market is valuing their entire AI business at absolute zero.
Let's look at how this builds into Wall Street's price targets, because the divergence here is just wild. You have that ultra-bearish target sitting way down at $30, which implies an 80% downside. But then, on the flip side, you have Raymond James issuing a street-high target of $800. That implies a staggering 440% upside. When you aggregate it all together, the average analyst price target across Wall Street sits around $245. That suggests a 66% upside from current levels, assuming, of course, the company can weather this week's storm.
Section 6. Approaching Max Q. Maximum pressure. Just to add a little more fuel to this incredibly volatile fire, Elon Musk actually took to social media over the weekend. Someone posted a claim that SpaceX could add $95 billion to $104 billion in annualized revenue, which is equivalent to Tesla's entire business, by the way, within the next 12 to 24 months. Musk simply replied, "Few understand." He also seemed to endorse another post calling the stock an insane investment opportunity. But we have to ground this in the reality of the numbers we just discussed. Even if they hit their $6.8 billion quarterly estimate today, their current annualized run rate is only roughly $27 billion. Getting to an additional $100 billion requires a scale of growth that, as of today, has just not yet materialized on the balance sheet.
Which brings us to our final thought for this explainer. Morgan Stanley perfectly captured this week by comparing it to Max Q, which, in aerospace, is the period of maximum aerodynamic pressure during a rocket launch. Over the next 48 hours, the pressure on SPCX stock is going to be at its absolute highest. Will the earnings catalyst and underlying fundamental strength allow the stock to stabilize and push through the atmosphere, or will the overwhelming gravity of a $100 billion lockup expiration just tear it apart and send it crashing down into two-digit territory? The countdown has officially started. So what do you think happens when that clock hits zero?